Hello and welcome to ChooseFI. I'm your host, Brad Barrett. And if you're new to the show, welcome to the largest financial independence community in the world. This is a community that numbers hundreds of thousands across the world. Our show has existed for 6+ years, and it's been a remarkable ride. And we're just so happy you've found us. The beautiful part about this community is, as we call it, this is the ultimate crowdsourced personal finance show. And the entire point of this podcast is to harness the collective wisdom of our entire community. And I think that is just such a wonderful, wonderful aspect. And what's cool about today's show, so we have one of our listeners, her name is Ginger, and she reached out to me a number of months ago when my co host Jonathan decided to step down. And she wanted to come on the show. And we've become friends over the intervening months. She's been on the show numerous times. And she had the idea to bring back something that we used to do, which was the Roundup episode. So every Friday, we used to do a Roundup, which was kind of a summary of our biggest takeaways from the Monday episode. She thought that was missing and it would be something fun to bring back. So while we're not going to do that every week, what we're trying to do, and this is an experiment just like anything else, we're trying to do this the last Monday episode of each month, where we essentially go back and talk about our biggest takeaways from that month's episodes. So again, this is the first in a series of experiments, but I think this is going to be a really positive development for the FI community and for ChooseFI. So with that, welcome to the show. Ginger, welcome back to ChooseFI. This should be a lot of fun.
Thank you. I'm excited to be back on the show, and I'm excited to do this more structured kind of roundup. I think one of the things that's so important about this show is it isn't just about entertainment. It's also about education. And so for me, I always liked the roundups because it helped me to sort of integrate some of those ideas, and hearing them from a different perspective made me think about it differently. And so I think this is just a good opportunity to review some stuff and help us to learn it a little bit better.
Nice. I love it. So before we get in, let's just do a couple of quick little updates. So first, again, under the guise of ultimate crowdsourced personal finance show, is what's beautiful is when we talk about things on the podcast, sometimes we get listeners who write in, and the easiest way to do that is to get on my newsletter. So choosefi.com/subscribe, literally hit reply to any of them and it comes directly to me. So Dennis actually reached out to us about something, Ginger, you and I talked about on episode 443, which is the last time you're on. We were talking about Hyatt, and Dennis he stayed at Hyatt, I think 98 times last year. So He's a massive Hyatt fan, and he just wanted to update me. I was saying how there's one award chart, and regardless of what's happening in that city, that it's just that one points charge. So I think my example is where like the Pope coming to town, or the Super Bowl was there, or Berkshire Hathaway event in Omaha, Nebraska. And I think I was directionally accurate, but Dennis wanted to update that Hyatt now has a new award chart that has a peak, off peak, and I think a normal. So there are slightly different charges, but I still think what I was saying was directionally accurate in the sense that they're not egregiously expensive. So if a category 1 for the standard night, which is the old award chart, is 5,000 points a night, it doesn't mean if, like I said, if the Super Bowl is in town, it's going to be 50,000 points a night. The peak is actually only 6,500 points a night. And actually off peak, interestingly enough, is 3,500 points a night. So there's some give and take here. But I think directionally, my point was accurate in that, hey, it's not based on what the actual cash charge is. There still is that award chart, but Dennis so appropriately updated that it's not just that one award chart anymore. So that was really important. And I also talked about the all-inclusives, and he wanted to note that as of March of 2023, there was a slight devaluation. So some of the all-inclusives went up significantly. But the one thing that I mentioned was that Hyatt has recently purchased a number of all-inclusives. They now own dozens of them, whereas it previously was only 4 or 6 of them. And there's a whole range of points per night. So while some of them were devalued, certainly, and that's absolutely true, there's so many more options now that I think it kind of balances out, maybe neutrally and probably to the good. So again, definitely wanted to update it because I never want to get things like egregiously wrong, but I thought that was an important update.
Oh, and there was another rewards travel thing that you created, right, Brad?
Yeah. So, okay. Yeah. This is important. I actually spent a whole lot of time, probably more than I should have, on creating probably more than I expected it to take, honestly. And I think that's that's maybe my own fault on how slow I can be sometimes. But for a very long time, I have wanted a top 10 travel rewards cards page on our site. So we've always had, okay, here's our top recommended card. And that's usually the Chase Sapphire Preferred. But that said, that's just one card. And many people have opened that card already. And we have an entire list of travel rewards cards at ChooseFI.com/cards. But that then is 50 plus cards. So there was no balance there, Ginger, where, okay, what if people are looking to go beyond the Sapphire Preferred, but they don't want to muddle through 50 cards? So what I did was I created this top 10 cards page, and it has a lot of my favorite cards. Like the current one I'm using is the Venture X card. There's a new American Express green card that has an amazing bonus that just came out of nowhere. So that's included in there. And the other thing is, I actually put into, my favorite is my Todoist app,
Mhm.
where I have all my to-do lists. I'm going to update this the first of every single month. So this page will be updated literally monthly, if not more frequently, when a new card offer comes out. So I hope that this can be a real valuable resource for our whole community. And as always, and it's important to note that really the best way to support us, because we don't have advertisements on the podcast, we try not to be upfront about, hey, we need to earn money or anything crazy like that. But if there's a win-win situation where somebody can use an affiliate link of ours and we make some money, and in this case, they get free or close to free travel, that seems like that win-win to me. So using our links certainly supports us. So if you go to ChooseFI.com/top cards, so that's plural, top cards, or we actually have this in our navigation bar now of if you go to travel rewards or travel, you can find it right there. So again, I hope this is a real significant resource. I know it's useful for me because I get to keep updated on what are the best bonuses at this point in time. So yeah, that was a labor of love, but I think it's important. All right, Ginger. So I think let's get into the roundup now.
Yeah, absolutely. Okay, so we're doing a month's worth of episodes. So let's start with Spending for Happiness, Carl Jensen and Doug Cunnington. That's episode 444. And we're just going to go ahead and talk about sort of our main takeaways, or what were the things that stuck out to us. So I will start with something that I'm wondering if you were curious about. I listened to this episode pretty much right after I had listened to Carl on Ramit's podcast. Have you listened to that one where he was on with Mindy?
Yeah, I've listened to bits and pieces of it, and I
Okay.
certainly saw the media uproar after it.
Oh, okay. I didn't see the uproar about it. But what
Okay.
was really interesting is listening to the ChooseFI podcast. He was talking about, he said, we don't bat an eye when we spend money on beers for our friends or whatever, right? And it was really in contrast with some of the stuff that he had talked about on the other podcast about it's so painful to spend. We haven't practiced how to do this. We have so much money, but we're not enjoying it, right? So my first takeaway, I was like, well, who is this inconsistent person, right? And then when I took a step back, I thought, okay, well, Carl is a person. He's not a character in a movie, right? And we change our minds about things and we feel differently about things on different days. So I can get over that pretty quickly. But then you want to ask yourself, like, what is going on? And here's what I came up with, and I wonder how you feel about it. I think what's happening is Carl is at a place where his values are shifting. And so if we think about like what's the takeaway for us, he used to really value, I think, financial security. That was the most important thing. And while that's still a value for him, it's not the one that requires his attention right now. So now what is requiring his attention is, hey, I value time with my friends and being generous and time with my family. And I thought this was an interesting way to think about it because it doesn't force us to say, well, what is the most important thing? What's the most important value? It's saying, what value needs my attention right now? So if you listen to both of the episodes back to back, you can kind of get like, oh, he's going through this process of where does that attention need to go? And it did make me think, well, for me, maybe I don't need to spend a lot of time on what do I value, but maybe I do need to spend on time on where does my attention need to be? Like what value needs my attention right now at this stage of my life? Does that make sense?
Yeah, it does make sense. I like that, the attention. And yeah, I think to your point, it may have been jarring, right, to hear those two episodes back to back, and it may have been inconsistent. But like you said, Carl is just a regular human being who's trying to figure it out. And I think
Exactly.
one of the frustrating things to me, the very few frustrating things that just in creating this podcast is sometimes people are like, oh, why don't you bring normal people on? You're only bringing bloggers and podcasters on. And I just find it such a preposterous thing, as if bloggers and podcasters, most of whom, the vast majority, like as if the implication is these are some famous people making boatloads of money, and 99% of podcasters and bloggers make $0 from their podcast or blog. And in fact, it's probably mostly negative. So it is literally a labor of love. There's somebody who just wants to document what they're doing. Maybe they think they can help somebody. So to say that these are regular, normal people is such an understatement. These are all of us, I myself very much included, regular, followable people who are just trying to figure out life as we go along. And sometimes we get it right, sometimes we don't. And like you said, sometimes we're just trying to figure it out and update our thinking. And that's okay. That's a sign of an intelligent person who, it's not somebody who sticks their head in the sand and only has one opinion for 70 years in a row. That's just not the way the world works. And it's been interesting to see Carl update his thinking in a lot of ways. And I mentioned in passing, and we'll probably come back to this, but his thoughts, him and his wife Mindy, on the money they might give to their children. And that has updated dramatically, where for years he was outspoken about, we're not going to pay for this, we're not going to give them an inheritance, et cetera, et cetera. Part of them growing up is them struggling, and I made it, et cetera. And then it seems as if that has changed 180 degrees now. Not that they're going to be pampered and they can just live ridiculous lives, but that, hey, maybe there's a way to do this better. And maybe there's a way to make their lives easier and facilitate them living lives of purpose and value. And I think that's kind of cool. So, anyway, that is a bit of a sidebar here.
I don't really think it is, because I think it gets to the heart of like what we're trying to do with the takeaways. And when you talk about that he's a person who changes his mind about things, and then we recognize we're people who can change our minds about things, that can be so freeing. And especially when we think, oh, I'm so scared to take action because I might make a mistake, I might do it wrong. And if you say, oh, well, actually, I can change my mind about this later, or I can assess later, I can think about this differently when my life is different, that can be a thing that can move people forward. So it's good to see examples, I think, of people changing their minds about things.
Yeah, I think you're right. And yeah, it's funny going back to Ramit and his show and kind of the sensationalism that occurred after the fact. Basically, the context was, oh, look, these are these two fire people who have $4 million in the case of Carl and Mindy, and they still can't spend. They're miserable. They can't do this. The implication is, doesn't that mean the fire movement is broken, or that everybody's cheap and misers? And it just frustrates me to no end. And honestly, Ginger, it shouldn't frustrate me as much as it does. But I mean, we here at ChooseFI have tried for 6.5+ years now to change the narrative of the entire fire. We don't even call it fire because the retire early is a distraction, but the fire movement to now really the FI movement, to make this accessible for regular people and for it not to be extreme. And I think we've done a pretty darn good job of it. I think we've democratized this for people all across the world. And then you have, of course, the Ramses and Ramit, who Ramit is very well meaning. He's super intelligent. I think he knows how to get attention. So, I want to be fair to Ramit, but who, of course, just uses as like a cudgel to attack us. And I mean, frankly, I think we, the FI community and the FI movement, and frankly, ChooseFI, we are the largest community of people pursuing FI in the entire world. We get to decide what the FI movement is, not these other people who are just looking for attention and looking for clicks. And we have decided that this is a movement based around value, purchasing what you value, spending time on what you value, and freedom and autonomy and purpose.
Yeah.
And I think that's the definition of FI, not let's be a miser and let's be miserable. And oh, look at these jokers, basically, as these guys are sensationalizing this too.
Yeah, that's something that you talked a lot to Carl and Doug about, this idea of figuring out what it is that you really value. And I guess my follow-up question to you is, how do we do that?
So how do we buy what we value?
Yeah, how do we figure out what we value? Because that is a process. What do you think you have done to help you figure that out? Or what do you think are things that other people could do?
Yeah. So I think this is all an experiment. I think honestly, life is an experiment. And there are different ways to approach this, but I think it all stems from, and I don't want to sound trite, but it all stems from taking action. So you can sit and think about this forever and never know anything, or you can make choices and try to see where you fall out on this. So some people, and I'm not necessarily advocating this, but some people decide to cut things out of their budget, essentially, and then slowly add things back. Or when they cut everything or cut many things, they'll wake up and say a month later and say, "Oh, I didn't miss any of that.
Hmm.
I missed none of it." So then, therefore, there was very little value there. But what if there are certain things that they absolutely missed? Well, you add them back and then it's obvious, right? That's one way to do it. I think another way would be simply adding something and then determining, hey, I think that's a little harder, honestly. But I think this is really important to talk about spending and spending for value. For instance, my wife and I, we're not big coffee connoisseurs, but I kind of got taken by like an advertisement that there was this really cool coffee company. They're a startup, and I wound up getting like a free pack at the beginning. The company's called Cometeer, and they send you these coffee pods, these frozen coffee pods on dry ice in the mail, and they're pretty expensive. They're like maybe $2 a cup, but honestly, like $2 a cup pales in comparison to what you'd spend at a fancy coffee place. And it seemed like a nice luxury. And we're like, oh, let's test this out, Laura and I. I have to say, Ginger, they're like, it's the best cup of coffee I've ever had in my entire life. And now,
Wow.
like going back to my Dunkin' Donuts coffee grounds, it just tastes really bad. So, it's one of those things where, okay, I added this into my life and I have to say it adds a lot of value. And sure, it's $2 a day or $4 a day, depending on if I have one or two cups of coffee. Is that really going to break the bank for me? No, it's not. And I tried to essentially stop, and I'm like, oh, I actually really kind of like this. This was something that was worth spending on. So I think that's kind of another way to go about it.
I love that example. And it made me think of another way into figuring out what we value is looking at what are the things that we talk about. Like, have you told a lot of people about this coffee thing?
I have not. This is the first time I've
Oh,
mentioned it publicly like this, but I did within the first week, like tell three of my friends about it who all signed up.
exactly.
Yeah,
So that's the little signal to us when we're like, oh, I keep telling people about this thing. That's a time for reflection of like, wow, this must be something that I really find a lot of value in.
that's brilliant. I like that a lot, Ginger. Yeah, I didn't even actually think about that, but you're absolutely right. Like, yeah, I'm not going to put, putting my reputation on the line sounds a little hyperbolic, but that's what you're doing when you're recommending something, right? You're basically saying, like, hey, I'm putting a little bit of my reputation on the line to say, like, hey, this is something I think is worthwhile and I love it and I'm talking about it. And hey, maybe you should try it too, even though it costs money, obviously. So, yeah, that's really cool. I like that.
Okay, so to summarize, if you're a person who's like, yes, I'm on board with being a valuist, I want to do a deeper dig into what it is that I value. We talked about three ways to do that: cutting, and then noticing what it is that you really miss, adding something and having that be a point of reflection, and also taking note of what it is that you're talking to other people about.
Yeah, I like that a lot. Ginger, what did you have any other takeaways from the episode with Carl and Duck?
Well, one thing I did want to talk about a little bit was something you had said about the addiction to saving being unhealthy.
Yeah.
Do you remember that part of the discussion?
Yeah, I think Doug said, quote, we were addicted to saving,
Mhm.
right? And yeah, I know that was kind of part and parcel around two other things I took note of: the skill of spending, how we need to optimize our spending on the front side of FI, like the beginning of FI, where clearly for most people pursuing FI, it's you do have to cut some things because, right, just by its very mathematical nature, if you're making a certain amount of money and you're saving zero, the quickest way to start saving is to start eliminating some items from your life. So I think getting smart about your spending on the front side is important. But then on the back side of FI is, okay, hey, maybe we were addicted to saving and that is unhealthy. And we have to realize that we have a finite amount of time and we need to start spending this for experiences, for the memory dividends, as we've talked about numerous times. So yeah, I mean, I think that's important. And I think it can start getting into this all pervasive, the thing I hear in my life. And I think people say this around me specifically when like they feel bad about spending something and they're like, oh, I know that's not very fi, but dot, dot, dot. And then they talk about something they were spending on. And I just, it makes me feel bad every time somebody says that because as if like I'm judging anybody. I mean, I don't care what you do. You do you, live your life. But the beautiful part about FI is there's no dogma. There's no dogma at all. It's you spend on what you value. And I think that again is the ChooseFI version of FI is there truly is no dogma. You have to save money, you have to take action, but I don't care how you do it. Do it however you want. But saving money can become unhealthy. And I think when you try to optimize and Ginger, when it becomes a keeping up with the Joneses in the FI community of, oh, my savings rate is higher than yours. And that doesn't exactly happen, but there's some little strain of it somewhere where people do feel like, oh, I'm getting to FI in 8 years and 2 months instead of 8 years and 4 months by cutting this out. And I just think that can be really unhealthy. There has to be some balance ultimately.
Yeah, I think it's important to note that where you said, "Oh, and it quite makes me feel bad." And when I think about, well, what makes it unhealthy? Like, how do you know when you're at that point where what you're doing is an unhealthy behavior? Maybe it's around looking at, okay, what are my emotions that are coming up around it? And where there is those feelings of shame or those feelings of urgency, then maybe that's a place to kind of take a pause.
Yeah, I hear you. And yeah, I mean, I think just trying, yeah, to find those triggers. Have you gone across some line of, hey, maybe I'm obsessing about this too much, right? Maybe I'm trying to optimize too much at the expense of living my life. And I think that is a really important update to the entire mindset of FI. Maybe from 5 or 6 years ago, we might not have thought that way. And I think it's very important to have some balance.
Yeah. Okay, so let's move on to the Fundamental Truths of Investing by Brian Feraldi, episode 445.
Yeah, this is a great one. So Brian's amazing. I absolutely love Brian, and it's so wonderful that while he clearly is an individual stock investor, and we've talked about that numerous times on our show, he still says that he recommends to 99% of people to dollar cost average into index funds, and that being your best chance of success in building wealth. And I think that's really important. And that's from someone who is an individual stock investor. So I think there are fundamental truths, interestingly, right? So that's the episode title, Fundamental Truths of Investing. And I think if you're kind of rounding to what should every single person do, and we don't give financial advice on this podcast, obviously, but I would say for the vast, vast, vast majority of cases, I think 99% plus is probably a good estimate. Dollar cost averaging into index funds is going to be your highest likelihood of maximizing your wealth over an investing lifetime. And Ginger, I mean, the coolest part about that is really the brain dead way to do it. And I say that in the most loving way possible. You don't have to outsmart anybody. You don't have to have insider knowledge. You didn't have to go to school to learn about finance or anything ridiculous like that. You just have to match the market, and you have to match the market at the lowest fees possible. And I think that's what is so beautiful about index fund investing. And I think even though that this obviously wasn't the vast majority of what we talked about in the episode, I thought it was just such an important thing.
Yeah. And of course, it's something that we've heard a lot. And yet, I think there's a lot of value in hearing it again. And it really makes me think about how, oh, yeah, like something you always talk about is it's not the math. Like it's not like the show is not about the math. The community is not about the math. The math is really easy. And so highlighting, okay, here's the thing that most people find success in doing. And now the chunk of what we want to spend our time thinking about is what gets in the way, right? What stops us from doing that? What's hard about doing that? But it's that itself is pretty straightforward. And what a relief. Isn't that great?
It is. It's amazing. And what gets in the way is usually our brain.
Yeah.
And so not only our brain and the maybe biases we have, but also short-termism, which I think a lot of people think in terms of quarters or what was the Morningstar rating on this stock or on this mutual fund. And that just is in most cases looking at a very short period of time, as opposed to I think we should all be thinking in terms of decades, multi-decades. And when you reorient around that, well, you say, okay, I'm going to keep my expenses low. I'm not going to buy expensive mutual funds. I'm not going to sell that often and incur taxation. So I'm just cutting down the friction. And again, because almost nobody, rounding to zero, vanishingly few people can beat the market over 30 to 50 years, almost nobody, honestly, then what's my best bet is to just match the market. Why do I need to? I can't outsmart it. I cannot outsmart the market over 50 years. I'm just going to match it. And that, again, is just a really reassuring place to be.
One thing I wanted to talk about from this episode was the idea of optimism and pessimism. And one thing that you said people think they're smart when they talk doom and gloom. And you said something about it's kind of hard to articulate why that is. So let's try to articulate it.
Ooh.
Here's what I think. I think it's just about vulnerability. And it's so much easier to be critical than to approve of something. And we see that across many different disciplines, many different subjects, right? It's something that I personally find pretty irritating, but it's so much safer. It's so much safer to be critical. So I'll give you an example from an old career I used to have. So I used to teach at a university, and we would do this thing called norming. So I was in the English department. So we all get the same paper, and then individually we grade it. And the idea is we're hoping that we come up with the same grade, or we talk about how to get to the same grade so that grading isn't this arbitrary thing based on the individual instructor. But what actually happens and why norming doesn't really work is that it's easier to criticize than to approve. And because the highest value in this culture is I want to appear smart. I don't want anyone to be able to poke holes in something that I say. So it's safer for me to say, this paper is terrible, and here are all the reasons that it's terrible, right? Because no one's going to argue with that. Whereas if I say, actually, this is pretty good for what this student is trying to do, then my colleague can say, oh no, like, look at all these horrible things. I can't believe you don't have high enough expectations. And so everyone ends up giving the paper a D, even though in their own classroom, they wouldn't do that. So that's the same thing, I think, in what you guys were talking about, where it's way easier to criticize this community or to criticize different arguments because it makes you vulnerable to say, hey, I find value in this, or I can see that this is a good idea.
Yeah, I like that. And I think it's funny, even the words that we use to describe it's always like naive optimism,
Mm-hmm.
right? As if, oh, they're just silly. They just have these rose colored glasses and they think the world is wonderful. But I mean, if we're all honest with ourselves, the world is pretty wonderful. I mean, obviously, it's not to suggest there's not bad things going on because there obviously are, and there always have been and always will be. But on a whole, the optimistic viewpoint is the right one in my estimation. And I think a lot of people like to sound smart and that realistic pessimist, like they're applying their intellect and cutting through and seeing all the negative. Like it just, I don't know, there's some allure to that doom and gloom. There's some allure to, oh, I've figured this out, right? Like
Yeah, it's
I see
protective.
the never-ending inflation coming and I see the next recession, and they're just BSing. They're just making it up. Anybody who claims to know anything about the macro landscape is just like they're a charlatan. I mean, there's vanishingly few people on earth who know anything about macroeconomics, who can predict anything with any degree of accuracy. They are charlatans and they are just trying to pull one over on you, in my opinion. You can tell how annoyed this gets me. Like, but yet they sound smart. They just do. And there's some allure to that negativity. So yeah, I mean, I think sure you see the word naive optimism, but I got to be honest, that's the right approach.
Okay, so I mean, I think the takeaway here from what we're saying or where we're coming from is just like, what's the end game here? And if the end game is this person really wants to sound smart and protect their ego, then I'm not going to give as much value to their opinion. I'm not going to weight it quite as much.
Yeah, I agree. And yeah, just a closing word on that particular thing is, as Brian said, I think he was quoting somebody else, maybe Morgan Housel, but perma bears get the clicks, but optimists make the money. And yeah, I mean, I think it's just really, really important. And again, also as Morgan Housel said, save like a pessimist and invest like an optimist. And I think that's the takeaway for maybe us in the FI community is I think that's what we do is we focus on savings rate, but we also invest optimistically of saying, hey, by investing in, let's say, the total stock market index fund, you're investing in 4,000 approximately companies, and the ingenuity and hard work and discipline of 100 plus million workers in America mostly and around the world. And if that's not a recipe for wealth building, I quite literally don't know what it is. And that's a very optimistic viewpoint.
So maybe we should wrap up our discussion of this one with a Brian Feraldi quote that sort of says it all, which is make money, spend less, invest simply, and wait longer is the best financial advice there is.
Yeah, that about covers it, right? I think we talked about this towards the end of the episode, and I think it's 9 words if you throw in the "and" in there, and those 9 words pretty much sum up what we're doing here in the FI community. It's, hey, you want to optimize your income, make money. You want to spend less. That doesn't mean spend nothing. It doesn't mean be miserable, but on some level, it means optimizing that skill of spending. Invest simply, like we've talked about. Probably the highest likelihood of success over the long term is low cost index funds. So there's nothing simpler than that. And wait longer is, again, we're optimizing for long termism, long term thinking, and thinking about this in terms of decades. So, yeah, I mean, Brian cut it down in 9 words to what I've probably spent a couple million words talking about here on the podcast, Ginger.
Okay, next up is Small and Mighty Real Estate Investor with Chad Carson. This is episode 446.
Yeah, this was a great one. I really enjoyed this episode with Chad, one of my favorite conversations in a while. And I think it's because, well, yeah, I mean, maybe it's some confirmation bias on my part. So let's be entirely clear here. But I think Chad just has it right. Whereas so many real estate investors talk about what's the most I can build, right? Like, how can I optimize for 100 doors? And that's the silly term they use to describe the number of places. Because I guess, like, if you were saying, and just as a sidebar, oh, I own a condo complex. Well, that doesn't exactly tell you how many units you have. So they basically break everything down into number of units, and they call that doors. So it's basically the number of different rentals they have, more or less. That's the layman's version of how to approach that. So for most real estate investors, it's how can I build this empire? Whereas Chad reoriented to essentially the exact opposite of what's the fewest number of rentals I can have to have enough to cover my life expenses and still live wonderfully. I mean, he was talking about, I think, $10,000 a month of expenses. And that's not nothing, obviously.
Yeah.
But when you've built an income stream, that's easy. And I think that was another massive takeaway was everything him and his business partner are doing in their business is to make their lives easier and to cut down friction, cut down stress. And sometimes that means essentially culling some properties that may have previously been something that they thought was great. And they don't fit the criteria anymore. We're going to get rid of these and we're going to look for, we talked about baseball a lot, but like a fatter pitch, right? We're going to find something that, okay, we've built up this knowledge over 15 years. We can sit around and wait now. We can wait for that next fat pitch to come along and find a property that's absolutely perfect for us and just makes our overall portfolio that much stronger.
Yeah. And I think this ties into something we were talking about before about how you don't want to let perfectionism get in the way of taking action and how you have to be able to change your mind later. And this is kind of part of that too, hearing him talk about it wasn't about, is this the absolute perfect property for me to hold for the rest of my life? It's this is the right property now, and we can reassess later, right?
Exactly. And yeah, as he said, it's try to find the 5% of the least hassle properties. That's what they're optimizing for amongst the working backwards. And Ginger, that was something we didn't plan this, but sometimes in an episode, you hit on a phrase. And it seemed like everything we were talking about in that episode was oriented around that working backwards, which is, hey, in this case, they have a number that they want to reach for their expenses in almost like a fat 5 version of their life. And all right, we're going to work backwards from that to build a portfolio that works for us and gets us to that number with the least amount of hassle possible. And, I know I've said this repeatedly now, but I just find that so wonderful and like heartwarming in a real estate world where it's always, and you see this unfortunately on Twitter and places like that of just, hey, what are the most I can have? What's the most leverage I can have? It's just like people who don't learn from history. And I think one of the things we didn't talk about in the Brian Feraldi episode was he talked about history and psychology essentially being the two most important fields to study. And I think that holds true in a lot of life. And in this particular case, when you talk about real estate, a lot of these people, if you really think about it, so we had the great financial crisis in the late 2000s, and it's been about 15 years. So if somebody was 23 in 2008, they're 38 now, and they've never experienced an issue with housing other than just up and to the right. It always goes up. Interest rates are always low until they
Mhm.
aren't right now. And of course you can leverage as much as possible. Of course you can, right? Like, and I say this sarcastically, but they've only seen the good times. But I think people who have an understanding of history have seen, oh, you have to actually plan for a rainy day. And you have to realize that things can go bad. And sometimes they can go bad really, really quickly. And if your entire portfolio is predicated on, we're going to pull as much cash out of this as possible and just keep on buying more properties, well, when things go a little bit bad in the economy and a couple percent of your rental properties aren't paying, this whole thing can come down like a house of cards. And I think it's just a really naive, in the worst sense, way to invest, in that assuming everything is going to go wonderfully forever. It's just, that's not the way of the world.
Mhm. What about where are you at with real estate? You've mentioned before that you kind of have at least dipped your toes in.
Yeah, I have two rental properties in Georgia, and I bought them both in cash. So it's similar to Chad in that, he has a little bit of debt. I think he said 15% or thereabouts, but it sounds like he's paid way, way down. But for me, it was okay, how can I sleep well at night? And having no mortgage, buying very low cost properties, that was the way that I could sleep well at night. Because frankly, if nobody lives in them, then the only thing it costs me is my, I guess, property taxes and insurance. And that's a little over maybe $1,000 or $2,000 a year. That's the worst that could happen. And so I'm capping my downside in this sense. And in fairness, they've been wonderful. I mean, Ginger, they've been absolutely wonderful in the sense that they've been continuously rented and they've provided a good return. I haven't had any major repairs other than when I bought them, I had to pretty much overhaul the entire thing. So I spent a lot of money on the front side. And, little things happen every now and again. I mean, there's things break or you need to take a tree down and it's whatever, $800 or $1,000, something like that. But overall, they've been pretty good returns. But yet, I haven't bought any more. So I think that's kind of like when I get down to the proof is in the pudding type scenario, it's like, okay, these have been great, but I still don't feel that strongly about them because obviously I haven't turned around even amidst the success and bought a third property, a fourth property, even though I basically could have. So they have been working for me in their very small sense, but yeah, I still don't, it doesn't sit all that well with me, even though I've cut the downside so much, Ginger.
But I wonder if that's because you have enough, to get back to his
Yeah.
thesis. And I would say, too, for anyone who is not really interested in real estate for themselves, I think this episode is still worth a listen for that discussion of, yes, we want to optimize, but optimize for what? And that gets to that point you were making about, where he was saying, I really don't want the hassle. And so that's something that's important to him and something he values. And so even just that discussion of what does it mean to have enough? What does it look like? How do we know when we're kind of moving beyond that?
Yeah, and it's interesting you talk about hassle, right? So there was actually two of our former guests. So we had Nick Majuli on a number of episodes ago, and then the Phi couple, they were on episode 430, and Nick Majuli talked about the return on hassle in our episode, and I thought this was interesting. So yeah, there's obviously a return, but there's a very different hassle level between index funds and real estate, for instance. Regardless of how passive you believe real estate is, it's not passive. It's just
Mhm.
not. There's a mental hassle, there's a time hassle. And there was a kind of big, I don't know, kerfuffle, for lack of a better term, on Twitter this week about the Phi couple had a post how in like 6 years they've grown to basically netting like $30,000 a year from their real estate portfolio. And I think a lot of people were surprised that that was a smaller number than they expected, in that there's a lot of hassle and that's 6 years of growth. Now, we know them to be wonderful people who are just building up this small portfolio and trying to do it right. But I think it highlighted, and I'll put the tweet by Nick Majuli in the show notes here, but I think it really highlighted that return on hassle better than anything. And it had like 1 million+ views, Ginger. And this really took off because I think a lot of people don't overtly think about that hassle, but I think they really should. And that was actually, again, we know the Phi couple to be some of the good people in real estate from what I know of them. But I think a lot of people took it as an opportunity to say, oh, all those real estate evangelists who are constantly talking about this is the best possible investing type and this is so easy, it's passive income, and then use it as an example of, oh, you mean you've spent all those thousands of hours and you're only netting $30,000 a year? Like, couldn't you have possibly done something better? So again, I'm not sure how well this is translating to the podcast, but I think it's an important thing to think about, that return on hassle. And I'm actually going to put a link to Nick wrote up an article about this specifically. I'm going to put that in my newsletter, most likely tomorrow that goes out. So again, ChooseFI.com/subscribe. That's really the best way to keep up to date. I write that on a weekly basis. So if you're listening to this podcast, you like the podcast, get on the newsletter. It's equally as important. So yeah, that's just a cool thing to be able to update almost in real time, Ginger, of what's going on in the community.
Okay, and last, we're going to discuss the Mailbag episode with Sean Mullaney, episode 447. Okay, maybe I'll start with a little clarification that I thought might be helpful for
Oh,
some
that's
people.
brilliant.
So, you guys talked a lot about the Roth conversion and the rules around that, and you can tell me where if I've got this wrong. But I thought if you're new to this idea of what a Roth is and what the penalties around it are, it could be helpful to understand that your contributions, we're not talking about doing a weird conversion, just like right now today, you contribute to a Roth. At any time, my understanding is you can take out those contributions without a penalty. The thing that you can't take out are the earnings on it, right?
Correct.
Yeah. So I thought if you didn't have that information beforehand, you might not have got that from the episode. And I do think it's a really important point to make because for some people, it can really be a safety net to think, okay, well, I'm not sure I have enough to invest in a Roth. Well, what if you think about it as part of your emergency fund?
Yeah, I love that,
You
Ginger.
do?
Love, love,
Does
love.
that make you uncomfortable?
No, I think that's actually really good because, right. And we did mention that at the end of the episode, so not the emergency fund. I think that's the brilliant point. But we did mention that Roth IRA contributions can be withdrawn at any time for any reason, tax and penalty free. And like Sean said, they come out first in the ordering rules. So when you do pull out of a Roth, the contributions come out first. So that's really important. But yeah, like you said, it's kind of an interesting way to think about an emergency fund in that, okay, if I wasn't going to make a Roth IRA contribution and I was eligible because, oh, I need to have my emergency fund. Well, you can actually make that contribution and you may never need that emergency fund, or you may, in the intervening months and years, save a whole lot more money, which in all likelihood, if you're on the path to FI, you will be doing that. And there's a high likelihood you'll never need to pull that contribution out. So it's actually then you've made that contribution to the Roth IRA and it grows in that case tax free because a Roth IRA is already after tax money.
Yeah.
So now that's why you can pull out the contribution tax and penalty free because you've already paid tax on it. That's the nice part about that whole concept is conceptually, that's why you can pull out the contribution because you've already paid tax on it. It's your money.
Yeah, it was one way that I got my husband on board a long time ago when I was like, oh, I think we should start to, we should open a Roth. Here are all the advantages. And we just weren't making very much money. And so he was like, what? Like, we need to have some money set aside more than we do. And when he learned this thing about how actually, if we really need it, we can take it without there being any kind of penalty. And then he was totally on board. So that might be the case for someone else out there, especially if you're just getting started.
Yeah, I like that a lot. So yeah, one major thing we talked about was how to break up with a financial advisor. And this is a question I get more than almost any other. And I think Sean did a really good job of covering it in the sense that, okay, he actually talked about the psychology of, all right, it's pretty hard to tell your financial advisor who you've worked with for a long time, hey, I'm leaving. So really the best way to do it is to physically call the new institution that you're moving the money to and have them lead it. This happens all the time. At that point, it's not personal, it's business, certainly for them. And they just start the process. And he talked about the ACAT, which I never heard before, but it's the automated customer account transfer. And you basically just ACAT out those existing funds and it just kind of moves along. And the other point he made, which is so appropriate, is it's in the new institution's best interest to do this, right? They want
Right.
to have your money located with them. So they're going to help you and hold your hand every step of the way. And I know from my own personal experience, it really is pretty easy. And I think I've done this Vanguard and Fidelity, possibly. Don't quote me on that, Ginger, but really they do. They just walk you through it. And I mean, they do this millions of times a year. This is old hat to them. So there ultimately is nothing to it. But if you started by calling your old financial advisor, what are they going to do? You know exactly what they're going to do. They're going to try to sweet talk you into staying, right?
Yeah, and I think that is a really valuable part to listen to, because that's one of those things that people can get hung up on, right? I don't know how to do this one step. It feels like too much emotional work to figure out how to do this step. And it's those times where it's really nice just to have a template for, okay, this is how most people do it. You take this step, done.
Exactly. And yeah, I thought to me, one of the most surprising takeaways, and this was a brilliant point by Sean, was if you have appreciated stock, right? So he called this the problem of appreciated stock. And I think this is actually a big issue for people when they're moving from financial advisor to some other institution is okay, they ideally want to get out of their old expensive funds or individual stocks in some cases into low cost index funds. And in a lot of cases, there are unrealized capital gains. So if you sold everything and moved it and kind of ripped the band-aid off, you might have a large tax hit at that point. So for a lot of people, it might mean, all right, I'm going to restart any new contributions that I make. I'm going to buy into low cost index funds or ETFs. But what do I do with all those unrealized gains? And again, this problem of appreciated stock. And he talked about if you're going to make donations, and this is so critical, and it doesn't have to be in a donor advised fund, but that is one way to do it. When you make a donation of an appreciated stock or fund, you never have to pay the tax on those unrealized capital gains. So, Ginger, just to make this more concrete, there would be two ways to do it, right? So, let's say I bought a share of stock for $1 and it's appreciated to $1,000, and I want to make a charitable contribution for $1,000. Well, how most people would think is, oh, I'm going to sell this stock and then I'll have $1,000 cash and I just donate the $1,000 cash, just like I would make any donation, right? I'm making $100 donation to here, $100 to there. I need the cash. But what would happen in that scenario is, and this is obviously a kind of ridiculous one, but when you sold that share of stock, you would have a capital gain of $999 because your basis is $1 in it and you sold it for $1,000. So that's a $999 capital gain. And you'd have to pay tax on that at whatever your rate is. So assuming it's long term, it's probably 15 or 20%. So that essentially makes your donation that much more expensive in that case. Well, the other way to do it, and most people don't realize this, is you can donate that appreciated share. Okay. So you actually donate the share of stock that's worth $1,000 to your charity of choice. And what happens is that $999 unrealized capital gain vanishes forever to you. It is completely gone. So you will never pay tax on that. It is a permanent change in that. It is gone forever. And you get $1,000 charitable contribution because it's the fair market value, the market value of that share of stock when you donated it. So, I mean, that is such an aha moment when you realize that of, oh, wow, this is one way that, especially, if I'm a charitable person and I might have some of these unrealized gains that have built up over a long time, especially in things that I ultimately don't want to hold anymore. Well, maybe over a period of years, I can donate these appreciated shares and essentially never have to pay that capital gain on it, which is pretty darn cool.
Is that complicated to donate stock?
It shouldn't be. It should not be. I think it's actually almost similar to what we're talking about with when you want to move something to a new institution. I personally would call up the charity and just make sure that this is something that they've done before and that they're okay with it. And I suspect it would just take a very quick call to them and or your financial institution. So probably the first time you do it, Ginger, it might be a little bit annoying in that like you just need to make sure, okay, here's how my financial institution does this. But similar to what we talked about before with something happening millions of times a year, this happens millions of times a year, I'm sure, with Fidelity, Vanguard, Schwab, et cetera. and they know exactly what to do. So yeah, I mean, this is something that it's definitely very replicable.
Mm-hmm. Okay, one thing I wanted to talk about from the episode was when Sean said, no one regrets not optimizing on their deathbed. And it made me think, okay, we need a little segment where we talk about what are the things we are not purposefully not optimizing. So I've got one. Can you think of one?
Ooh, that's quite a challenge, Ginger. I'm not sure that I'm ready for that, but let me hear yours first, and then maybe I can think of one on the fly.
Okay. So I am a counselor and I am paid per client, right? So that means I don't have any vacation time. So when I take off work, I just don't get paid. If I take off for a week, I don't get paid for that week. That is hard for me, right?
Yeah.
And it psychologically, it can make it hard for me to take vacation or to even if there's some time where I just want to take one day, I do way too much work inside about like do I really want to give up that day's pay for this other thing? Well, that can get to a point where it's actually this is that thing where it's actually not super healthy. Like I should take vacation and I don't want to do these mental gymnastics every time. So I was thinking about how I'm kind of jealous of my friends who have paid vacation. Well, there's nothing really to be jealous about. Paid vacation isn't a magical thing. It's just actually your rate, your hourly rate is a little bit higher than you think about it as. And your employer puts it in a special place and gives it to you at a certain time. That's all that it is. So I thought, okay, I can do this myself. And every month I can take out a little bit of money. That's my vacation fund. And then when it comes to those months where I take vacation, I pull from that. So I have a more even paycheck. Okay, this is not the optimal way to do it. I'm going to lose money doing this. Because what I should do is when I have the money, I should take the money. I should put it into savings or whatever else. I shouldn't be putting it in this crappy checking account where it's just going to sit until my February vacation, right? But to me, I was thinking when I thought about doing this, I felt such relief. I thought, oh my gosh, I'm going to feel so great when that month comes and I'm able to pull from that fund and feel good about my paycheck that month.
Hmm.
So that's one way that I'm not optimizing. Or I guess we could say I'm not optimizing for the best return.
Right.
I'm optimizing for peace of mind.
I like that a lot. So yeah, it's funny as you were talking, the two things that came to mind for me were exactly that. So I'm optimizing for something. I'm just not optimizing for total return. It's
Right.
also peace of mind in my case. So the most obvious one for me is I keep way more money in my checking account than I should. And now there is an opportunity cost to that. In fact, you could argue that's my emergency fund to a large degree. Like I just leave it there. If I have a higher credit card bill or something because something popped up that month, okay, well, there's a buffer there in the checking account and I don't have to worry about it because what I'm actually optimizing for is stress mitigation. That is literally what I'm optimizing for. I don't want to think about, oh my goodness, am I going to overdraw my checking account? Or is the electric bill $170 this month instead of $99 or whatever it is, right? Because if I know people who keep their checking account essentially down to the dollar of what they're going to have come in or out. But what if something else popped up? Like, what if you had some recurring bill that you had coming debited out of your checking account that you just forgot about?
Mm-hmm.
You overdraft the thing? I mean, that probably works for some people, and I don't doubt it, but that doesn't work for me. So I definitely want extra money sitting in there, even though I could be investing it. And yeah, I guess the other one is almost similar in that I moved some cash over to my investment company. And instead of just investing it all in one fell swoop, which I know is the mathematically optimal way to do it,
Mm-hmm.
and it's such a small percentage of my net worth. Like I know every part of me says, Brad, you're being an idiot. You should just invest this all right now. I just set up a recurring investment over a number of weeks to put it in essentially dollar cost average. So that's probably not even the exact right term in this scenario, but because it makes me feel better. And what I'm foregoing in opportunity cost is so small that it makes me feel better part just far exceeds any downside for me at least.
Yeah. And I suppose that's an important part of the equation too. When I was doing it, I was like, oh man, I feel so much better when I think about it this way. Well, yeah, I'm going to lose money, but I don't know, $200, maybe less than that. And that's worth it to me for, hey, I'm going to feel good about taking vacation for a year.
Yeah. And in your case, like you said, I mean, that's a big deal too, right? Taking vacation as opposed to feeling guilty about it every time or,
Mhm.
oh, why am I not optimizing? I shouldn't be doing this. It's no, I mean, taking vacation is really important. So, yeah, I mean, you found like a really great hack to kind of work around that maybe bug in our human operating system to some degree.
I would love to throw that question out to the community as well. Like, what are the other things that you're doing where you are not optimizing for return? What does that look like, and how has that played out in your life?
Yeah, that is a great one. That's a really great one. So, as always, like we said before, choosefi.com/subscribe will get you on my email. I write the thing. Any response to that comes directly to me. And yeah, I'll collate them. And Ginger, we can talk about that. Again, Ultimate Crowdsource Personal Finance Show. Let's show that. That's what this is all about. So we would love to hear your ways that you're not optimizing maybe for return, but optimizing for life. So yeah, that's a cool challenge, Ginger.
Optimizing for happiness.
Yeah, I love it. I love it, love it, love it. All right, well, this was fun.
Yeah.
I think round one of our experiment here, this certainly
Mhm.
worked. So we'll have, I guess, the last Monday in every month, as long as we continue the experiment, will be this roundup episode. So yeah, I think this is great. And Ginger, as always, thanks for joining me. So if people want to find you, you have a website?
Yep, you can head on over to fiisfun.com.
Nice. That never fails to bring a smile to my face. Fiisfun.com. That's so great. So, all right, Ginger, until next time, thanks again.